According to Fannie Mae, weekly mortgage rates have decreased for 6 consecutive weeks. So therefore, how is this impacting our current U.S. housing market? I'm going to share a new report from Redfin to share all the details. Let's go ahead and dive right in. This is an article just posted today, which is on March 13th. Can't believe it's mid-March already. Anyways, it says more people are house hunting and applying for mortgages as rates are decreasing. As you guys all know, I'm a licensed loan officer here in California, also an agent in Sacramento. We're also seeing an uptick in people reaching out as well. But it says here more house hunters are touring houses as rates are decreasing. But the key words here, the key summary here is this causing home sales to rise overall nationwide? So application numbers rose by 7% for the week to the highest level since the beginning of February, as weekly average rates dipped to the lowest level since mid-December. On top of that, people searching for homes for sale on Google increased by 10% year over year to the highest level since July, and Redfin's Home Buyer Demand Index, that is an index which measures the amount of home tours and other home buying services they're getting from their agents, actually increased to the highest level since the start of the year. So these are all leading indications of future closed home sales, right? Application numbers, people searching for a house for sale, on top of that, application numbers as well. So we're seeing uptick, but has this translated yet to more home sales? It says this is not translated to an uptick in home sales because pending home sales, a measure of home buyers getting their offers accepted, decreased by 6.1% year over year during the 4 weeks ended March 9th, on par with the decreases over the past few months. Now, of course, every market's different. I'm personally seeing here in Sacramento, overall, it's not as hot as it was back in 2022, of course, when rates were at 3%, but it still overall is still competitive. Also, there's some pockets as well that's very competitive as well. I just placed an offer for a client, 2 days ago for around $1 million. The home seller received 8 offers within about 4 days of the house being listed for sale. And our offer at the asking price was the lowest offer amongst those 8 offers. So it can depend on the house, of course, but also the neighborhood and also the city as well. In contrast, in areas that have a glut of house for sale, obviously you're seeing probably just the opposite, houses sitting in the market longer than in previous years. Now, Redfin's economic research lead had a really good breakdown regarding rates. She said mortgage rates are coming down because the country's economic outlook is getting stormier as investors worry about things like tariffs and a slightly weaker than expected jobs market. Lower rates have brought some house hunters who were waiting for costs to come down off the sidelines, but they haven't led to more sales because prospective buyers are still figuring out whether lower payments are enough to justify a home purchase in today's uncertain economy. Many Americans are concerned about things like job security and a potential recession. So please leave me a comment below. If you guys are a home buyer looking to buy a house, what is keeping you from buying a house? Are you seeing a lack of house for sale? Or are you guys more concerned about what's going on in the economy and of course abroad? I always welcome your feedback and what you're seeing and also what your confidence level is regarding our housing market and our economy as well. So again, please leave me a comment below. So that's the demand side, right? Not light, right? Let's talk about the supply side. So new listings, this is a measure of people listing their house for sale. That rose by only 3.1% year over year, similar to the upticks over the past several months. We expect listings, of course, to continue to rise because listings tend to kind of peak in the late summer months or late spring and summer months. And here we are just approaching the spring home buying season. So let me break this all down for you guys because we're seeing lead indications showing that we're going to see an uptick in sales in the coming months. But again, that has not translated to more sales because pending home sales fell by 6.1%, despite the fact that new listings rose by 3.1%. So demand going down, but supply actually going up. One thing I will say, and I'll share how active listings or housing inventory compared to last year. We're not seeing a sharp uptick of inventory on national level because new listings are still increasing at a slow pace. I was going to share this later in the video, but let me just kind of break this down for you guys right away. This is from Realtor.com for the month of February, posted on February 27th. So regarding new listings, Have a look at this. What I love about Realtor.com is that they share how the stats we're seeing today compared to 2017 through 2019, whereas Redfin only shows back to, I think, 2021 right now. So according to Realtor.com, the gap in new listings compared to pre-COVID levels was the lowest in the South, where new listings were down by 5.8% compared to pre-COVID levels. In comparison, or I should say in contrast, in the West, they're down by nearly 16%. They're down by 20.5% in the Midwest and down by nearly 35% in the Northeast. So we talk about this a lot, right? In the Northeast, parts of the West, we're seeing a lack of house for sale compared to pre-COVID levels. In contrast, the South is the region in the US that has experienced a huge uptick in listings and inventory levels overall. In fact, among the 50 largest metros, 15 metros saw higher inventory levels compared to the typical 2017 through 2019's levels. In fact, the top metros that saw the biggest increases of inventory levels, or the amount of houses for sale, was predominantly in the South and West, which included Denver up by 57% compared to pre-COVID, San Antonio up by 47%, and Dallas up by 39%. In any case, as you guys can see, every market's different. So of course, the stats that you're seeing in your area may vary widely compared to what we're seeing on a national level. So let me share an update regarding mortgage rates, of course. So here is the Mortgage News Daily. Let me actually just go back here. So this is the Mortgage News Daily as of March 13th. They basically survey hundreds of lenders across the country and ask them, what is your best rate for someone looking to buy their first house? They want to live in that house. They have a FICO score of 780 and they're putting 25% down. So what is your average rate for that person? Which is basically the most competitive rates you're seeing on a national level. So based on that survey as of today, the average 30-year fixed rate is at 6.78%. That is a decrease of 4 basis points compared to yesterday. Jumbo's at 7%. FHA and VA loans is around 6.22 to 6.24%. Now click on the 30-year, and then just looking at the Mortgage News Daily, that's daily rates. Daily rates haven't fluctuated very much for about a week, but at around 6.78%, just below 6.8. This is more or less on par with the lowest levels going all the way back until December last year. Also quite a bit lower than the peak this year so far, back in mid-January, when the average rate was at 7.26%. On top of that, at 6.78%, this is also lower than 1 year ago this time, when the average rate was at 6.94%. Now going back to Redfin's article, according to Freddie Mac, they have a weekly survey that was at the lowest level since mid-December for the week ended March 6th. And again, looking at application numbers, people applying for loans to buy houses, that rose by 7% compared to 1 week ago. Actually, let me just share the exact article on this. This is from the MBA. They announce a survey every Wednesday. If you guys are curious, I think in the early morning hours. So the most recent survey we have from them is for the week ended March 7th, just announced on March 12th. This is something really interesting. The refi index, this is the amount of people who are applying for loans to refinance their current mortgages. That increased by 16% compared to the previous week, and it's up by a whopping 90% compared to the same week 1 year ago. I'll have to say though, this is a huge percentage based on a low level, right? 1 year ago, refis were basically non-existent. So a 90% increase based on a very low number is still a very low number, but albeit a very high percentage. So what I really focus on though is the seasonally adjusted purchase index. That is the measure of people who are applying for loans to buy houses, and that is seasonally adjusted. That increased by 7% compared to 1 week ago and was 4% higher compared to 1 year ago. So according to Joel Kahn, who's the MBA's vice president and deputy chief economist, he stated the following: rates have decreased for the 6th consecutive week, with a 30-year fixed rate dropping to 6.67%, the lowest level since October of 2024. So because rates have been coming down, this makes sense. We're seeing an uptick in application numbers. And here's something really interesting as well. So they actually look at the percentage of applications that are refis versus purchases. And historically speaking, it's common to have a low level of refis compared to a relatively higher level of purchase applications. So right now, around 45.6% of all applications were from a refi. Pretty wild, right? About half the applications, even though we have rates just under 7%, half the applications are from a refi. And of course, 65% or 55% are for a purchase. Now, something also interesting as well, we're actually seeing a small uptick in people applying for loans using an ARM or an adjustable rate mortgage. That increased to 7.2%. I believe the 2-year time frame of this, the low point was at around 3% a couple of years ago. The high point was around 12%. So we're more or less in line with right in the middle of the low point and the high point over the past 2 years. And of course, I'll keep an eye on this because we do not want to see the share of applications increase for ARMs, because those are more risky loan products because they're only fixed for a short period of time and then they became variable thereafter. In other words, your interest rate and payment adjusts once you get to that variable rate term. In contrast, a 30-year fixed rate mortgage is fixed for your principal and interest for 30 years, a much less risky loan product. All right, let's change gears slightly here and talk about home prices and much more based on this data from Redfin. Again, this is for the 4 weeks ended March 9th this year. They look at 400 plus US metros, and their weekly housing market data goes back to 2015. It would be great if they included 2008, but again, their data only goes back to 15. And of course, it's subject to revision. So let's talk about prices based on the median sold price on a national level. That was at $381,975, up 3.2%. Something that caught my attention as well regarding this is this right here. To start the year, the median sale price was up by about 5%. Then it decreased to about 4%, and now it has been to about 3% for about a month now. So home prices are still higher compared to 1 year ago, but it is actually decelerating, going from 5% now to 3%. We are seeing a seasonal uptick in home prices, but the growth rate in prices is not as sharp as what we saw last year. So for example, this time last year, we're up by 5%. And again, this year, we're up by 3%. Also looking at 2022. I mean, it's just laughable. I just kind of forgot about how crazy the prices increase. At this time in 2022, on a year-over-year basis, the US median sold price rose by a staggering 17%. In contrast, in 2023, we were down by 1%. So in early 23, that was the first time in over a decade that home prices fell on a year-over-year basis. So therefore, we've had quite the volatility over the past several years. All right, let's have a look at the relationship between demand and supply. Again, this is a really good snapshot looking at this. Again, pending sales decreased by 6%, but new listings rose by 3.1%, and active listings, which is the pool of houses for sale or housing inventory, that rose by 9.3%. So demand decreasing, even though supply is rising year over year. So one of the reasons why supply is rising but not skyrocketing is due to the fact that new listings are only increasing at a slow pace. So here's new listings up by 3.1, obviously higher than last year, higher than 2023, but lower than 22. Like I mentioned, according to that article from Realtor.com, we're still well below pre-COVID levels as well. It would be entirely different if new listings were going like this, right? If new listings were basically going straight up, that would cause inventory levels to skyrocket, which of course would put big downward pressure on home prices. But right now we're not seeing that because new supply is increasing at a slow pace. Also, pending home sales are down by 6.1. That is at least a 3-year low during the same time frame. Meanwhile, active listings rose by only 9.2%. This is actually a deceleration compared to the nearly 17% gains we were seeing at the beginning of the year. And also pretty interesting that back in 24, inventory was increasing during this time, whereas this year has been relatively flat ever since really around late January this year. Meanwhile, the month supply is only at 4.1 months. I believe in Sacramento, we're less than 3. I think it's around 2.5. Also in California, we're less than 3 as well. So every market's different, right? But on a national level, we're at 4.1 months. That is an increase of 0.6 points compared to 1 year ago. But at 4.1 months, that's the lowest level of the year. All right, I have some more trends to share with you guys, but I also want to share how each of the 50 biggest metros fared regarding home prices. They look at the 50 biggest metros. So the biggest increases on a year-over-year basis were Milwaukee, Wisconsin, up by staggering 15.7%. Then we have Cleveland up by 13%, Anaheim 11.7%, Nassau County, New York, I'm probably mispronouncing that, probably do that every single week, up by 11.5%, San Jose up by 10%. What is astonishing about that number right there, overall, the median sale price in San Jose is over $1 million. So a 10% increase on $1 million is $100,000 more, right? But the average home price is well over $1 million there though. Anyways, in contrast, there's actually 5 metros that are down year over year, and they're all located, with the exception of Atlanta, in Florida and Texas. Austin, Texas, down by 3.9. Jacksonville, Florida is down by 2.6. Tampa, down by 2. Atlanta, down by 1. And San Antonio, down by 0.8%. This means, of course, that there's 5 down. This also means that 45 have increased compared to 1 year ago. In regards to pending home sales, that increased in only 4 metros. Pretty crazy, right? Los Angeles, Anaheim, Columbus, Ohio, and Sacramento. Sacramento up by 1%. In contrast, the biggest declines are Fort Lauderdale, Florida, Warren, Michigan, Houston, Atlanta, and Detroit, all down by more than 14%. So this is pretty crazy, right? Demand versus supply. So demand, there's only 4 metros out of the 50 that increased, right? But roughly half of the US metros, half of these 50, experienced a gain in new supply hitting the market. So more metros experiencing a gain of inventory levels compared to only 4 metros experiencing gains in pending home sales. So anyways, in San Jose, California, that led the nation up by a staggering 35.7% increase in new listings. Sacramento up by 27%. Then we have Oakland, Phoenix, and Los Angeles. In contrast, we saw big declines in Detroit, down by 18%, and also declines in Warren, Michigan, Austin, Texas, Fort Worth, Texas, and Milwaukee, Wisconsin. All right, let's get back to the month supply at 4.1 months. Like I mentioned, that's the lowest level of the year so far. But looking at the same time frame, because again, this is not seasonally adjusted, at 4.1 months is at least a 3-year high right now. However, having said that, we are seeing a seasonal decrease in the month supply right now, just like we do for every single year. Let's also have a look at the average sale price to final list price ratio. For the week ended March 9th, we're at 98.3%. This means out of all the houses that did sell, they sold for 1.7 percentage points less than the seller's asking price. This is more or less in line with the past couple of years, but at 98.3%, this is well below with what we saw at this time in 2022. Back then, everyone was rushing to buy a house before rates were increasing further. At that time, the ratio was over 1%. So on average, homes selling about 1% over the seller's list price. And now again, they're selling slightly below the seller's listing price on average. With that said, if you guys want a real estate agent referral, then please check out my website, which is realestateteamfinder.com. Also, of course, I'm a licensed real estate agent, or sorry, I should say a licensed loan officer here in California. I'm also going to get licensed in Texas and Florida as well here very, very soon. And when I mean soon, I have no idea, but here very, very soon, I'll keep you posted regarding that as well. Hope you guys appreciate these timely housing market updates. I'm not posting as much as I used to, but I'm doing my best to provide my own analysis about what's happening in the housing market. So please leave me a comment below with your thoughts regarding what's happening right now. What are you seeing in your neck of the woods as well? With that said, I appreciate everyone watching today's video. Please like and subscribe, and we'll see you in the next video.